Hi, everybody. Thank you so much for sticking with us. This is the last session of the day, so get you energized a bit, perhaps, with some audience interaction. Who in the room, please, is working directly on climate finance? Ooh. 2, 3. Who of those people are working related on climate finance related to mitigation? 2. And what about adaptation? Sort of.
Both.
Cool. So that's like a bit of an imbalance, which might be a little bit symbolic of what we're going to talk about today, and that's the gap of climate adaptation finance. So we're 2 weeks from COP27, guys, and as usual, the money is going to be key. In COP26 in Glasgow, countries agreed to double adaptation finance. Now, climate vulnerable countries that are at a lot of risk from climate change impacts, want climate finance to be split 50-50, adaptation, mitigation. Mitigation being money to reduce emissions in the first place, so things like investing in renewable power, electric cars, that sort of thing. And adaptation finance being slightly different. That is things like early warning systems or upgrading infrastructure. But the adaptation money is really, really lacking. But it's what's often most needed by the lower income countries who are very much at risk from climate change. So here today to talk about what role private finance might be able to have to fill that gap. We've got some great speakers with us today. Thank you very much for joining us, both us virtually. First, Annalisa Brison, a Senior Research Fellow in Development and Public Finance Programme at the ODI think tank, and Cynthia Lozenzo, Lead Climate Adaptation Expert at the European Investment Bank. Thank you very much both for overcoming poor health and joining us virtually. With us on stage, we have Ranil Dissanayake, Policy Fellow at the Centre for Global Development, and Denise Harut, Executive Director of Pollination, a climate change advisory and investment firm. So let's get talking. Ranil, so one of the major problems around adaptation is that there is still some politics around how it's actually defined. Can you talk a little bit about the problems around defining adaptation finance?
So, in theory, the definition of adaptation finance is pretty simple. It's anything that helps you really deal with the consequences of climate change, and really it should be core to sort of what development is, in the sense that we know that the climate is changing, we know that the environment is changing, and this will have consequences for the optimal path for development for many poor countries. And adaptation finance should be aiming to support them in finding the best way through to adapt to these changing circumstances, the best way to develop despite these changing circumstances, or through these changing circumstances. In practice, though, adaptation finance, if you look at the nitty-gritty, if you go into a database and look at every project that's listed as adaptation finance, it can be virtually anything. People will cite a education program as adaptation finance if it sort of might have some sort of tenuous relation to supporting people think through how the changing climate might help will affect them. So there's a practical problem here, which is that you can call almost anything adaptation, or certainly you can call much more as adaptation as you really probably should if you were being really intellectually honest about it. There's also a political problem, which is that adaptation finance is done correctly. It's a development intervention. It's an intervention that supports poor countries or poorer places. Mitigation finance, on the other hand, is more like it's a global public good. Rich countries will also benefit from that. And the incentives are very much for rich countries that want to limit their outlay on climate financing to focus very much on things that will benefit them more directly. And so that's the sort of crunch point here. And it's striking that in the sort of September Dakar ministerial for LDCs, they focus very clearly on adaptation finance, calling for much more of it, and for much more of it to be public and grant-based actually as well.
Okay. Cynthia, I wonder if I could just come to you on that question as well around the definition of adaptation finance. Since you've been working in this field for 15 years, do you have anything else to add on what Randall's just said?
Thanks very much, and apologies first of all for not being able to be in London with you. Can you hear me okay?
We can hear you fine.
Excellent, thank you. So I am Cinzia Losen, I work for the European Investment Bank, or EIB. And my role in the bank is to really look after EIB's strategic and operational approach for investments in adaptation and resilience globally, so across all the sectors and all the regions of operations. And I also have the privilege of co-chairing actually, the working group of the multilateral development banks working on adaptation finance. So I think I can help with the discussions on adaptation and its definition. And it's not a trivial one, as you have rightly highlighted. And whilst it is true that in principle, adaptation is about really helping people, businesses, communities, also ecosystems and natural assets in dealing with the negative effects of climate change, the type of investments through which you can do that is not necessarily very clearly defined. And this is because you need to adapt every single sector and every single activity of your economy if you really want to build resilience. So adaptation to climate change requires investments in all sorts of actions, and therefore they tend to be, let's say, a small part of possibly a broader, bigger type of investments. And you mentioned education. So you can find adaptation finance in an investment that is much broader, for example, to update a national curriculum in secondary education. An adaptation component will only be about maybe introducing climate change, science and its impacts to students in secondary education. So adaptation investments tend to be blended within investments that have broader objectives. This is particularly true in the development context, of course, where there are a variety of priorities that require financing, and adaptation is, let's say, we say mainstreamed in all sorts of other investment priorities. However, I think this is perhaps what used to be the old understanding of adaptation, and over the course of the last decade or so, as we have invested more and more, financed more and more actions that really contribute to address the negative impacts of climate change, like extreme heat and flooding, increased rainfall, sea level rise, storms, etc., etc. We also realize that, in fact, there are a number of investments that can be supported to transform the way certain services are provided to make them more climate resilient. So I think the definition of adaptation has changed quite a lot from what it was in the past as simply an incremental improvement, adjustment of an investment, to now really also be considered as a need for some deep transformation in the way certain services are provided. I can give you some examples. We would define as incremental adaptation perhaps the way a road is adjusted to better cope with increased rainfall. So you would increase the capacity of the culvert or the drainage system of the road to improve its performance, ensure that the road can provide the service, mobility of people and goods, also under a scenario of increased extreme rainfall. that's one example what is an incremental type of adaptation. It's an adjustment to something that you will be doing anyway. You just need to do it in a slightly different manner to take into account the impacts of climate change. But now think of a country that is water stressed and has no reliable long-term source of water to meet water demand, and needs to move completely from perhaps abstraction of water from underground sources to, I don't know, to a totally different technology like desalination and supply conveyance systems to bring water from the sea to different regions inside this country. That requires a complete transformation of that sector and a totally different scale and type of investments and analysis and support and capacity building to really move to a different path to climate resilience. So that sort of investment, we would call it a bit more transformational, and it's no longer a simple adjustment to an old way of doing things, but actually it's a very different way of providing that services as a response to the threats of a changing climate. So I hope I give you a sense for, really what adaptation can look like in different contexts, and also the different types of adaptation that now we understand, from the very small incremental support to the much more transformational change needed in certain countries and in certain systems.
Thank you. That transformational support, Cynthia, is that one of the reasons it's so hard to raise capital specifically for adaptation?
Partly, of course, the transformation requires significant volumes, but also it's not just about the quantity of the finance, it's also about the quality, and we already mentioned this, the type of concessionality of the finance to really enable these transformations, but it also requires availability, therefore, of capital that is not so expensive, requires de-risking to really make that leap of faith and supports that type of radical change. It requires high levels of technical knowledge to design those systems in a way that really can cope with a more variable and changing climate, so really designed for the future, future-proofed. And therefore, all of these elements make that investment very complex and make that investment perhaps less interesting to private sector actors. And this is why public banks have an absolute crucial role to play in adaptation finance, not just because of the provision of the public capital, but also as a way of de-risking investments and attracting, therefore, private sector into it.
Okay, great, thank you. Luckily, we have a representative from the private sector. Yeah. So we've heard about some of the difficulties, Denise. What are some of the incentives for the private sector to become involved in adaptation finance?
Very good question. First of all, thank you so much for sharing all the complexities and difficulties and leaving me with the difficult question around how to mobilize private finance. But just as an introduction to myself, I work at the very intersection of climate and capital at a firm called Pollination, as Will has introduced. We are a specialized firm that advises some of the largest companies and global investors on decarbonization of portfolios and therefore the real economy in line with the 2050 net zero targets, and also help them sort of get their head around what does net zero nature positive mean like, and what sort of different investments that they need to think about when they rethink their capital allocation strategies. We also have an asset management arm, which is small but growing, that helps channel investments into nature, climate, and subsequent growth opportunities. And to respond to your question, I mean, I don't want to be the boring climate person on the panel and sort of share all sorts of doomsday facts as it normally happens. But given we have so few of us who work in the climate finance space in the audience, I thought I can maybe respond to your question by explaining how the capital markets, therefore the investors, are approaching the topic of climate and nature, and what is sort of adaptation's role within that, if that's helpful. I mean, one sort of key message that I want to share is that the climate is changing, and we're not just talking about global warming and the risks associated with it. The shift is much more than just what's happening in weather-wise. I was reading a survey just this morning of 800 institutions globally by Nuveen, which is a mega investment firm that manages more than $1 trillion worth of assets. And the survey is on their asset owners and consultants who are, or what are the ways of them re-examining the traditional approaches to investing as they grapple with the high volatility in the markets that we're seeing today, the energy crisis, the food crisis, rising inflation, tightening monetary policy, and ongoing disruptions that we are observing in our economies with increased awareness around social inequality that it will lead to. We observe at Pollination that the net zero is becoming new normal, and that's very much a key risk that the investors highlight, but also a key opportunity as they rethink their allocation strategies. And there's widespread recognition that capital markets will lead that transition rather than policy actions and the public sector. I mean, this group can debate that. I'm not saying this. This is the Nuveen report. And the climate and nature impact, particularly understanding the risks related to climate change, is now foundational to institutions building their portfolio and reimagining the ways that they will sort of attach a dollar value that incorporates that climate and nature component as well. And that's going to be like foundational in transitioning to more resilient economies. So the financial services talks about resilience a lot nowadays when they think about climate risk and mitigation. So in other words, I think what we are observing at the moment, particularly in Europe, but globally, is the biggest disruption and change in financial markets since the Industrial Revolution. That it has been led by understanding of that climate risk and mitigation. Obviously, Silvia said a lot that this requires some transformation, transitioning the economy to address the climate and nature crisis will require a transformative change across energy, across business, across finance, and that requires some public-private cooperation, but also it unlocks, I think, the greatest investment opportunity that we will encounter in our lifetimes. There are numbers flying around, 140 trillion being the total size of the opportunity, like trillions needing to sort of flow to climate finance and adaptation every year. But how do we unlock that is, I think, the focus of this conversation today, right? Now, we talk about climate risk as being investment risk, but we also heard there are like significant differences on how people approach or define that risk, and that's also very much the case in private finance also. And as we set the standards, set the frameworks, and sort of finesse these definitions around what is adaptation, what is 1.5 degree aligned investment, what is Paris aligned investment. I think that the focus of the investors are shifting from also just risk to, okay, what are the opportunities and what is climate smart way of investing. So it's quickly evolving from just being a risk framework to okay, this is going to be the biggest trend of the next decade. And there are a lot of like very big questions being asked, and the responses require high integrity judgment calls on a very subjective topic today, which is, I guess, one of the key hurdles or key barriers around why finance is not moving quick enough. So people don't yet have that high integrity judgment call to make around where to put money that will define the next decade or so. But what are some of the important levers that will need to be pulled when it comes to adaptation? As the integration of climate and nature in mainstream investment continues, how can the international development and development finance community define their sweet spots between high risk, high impact situations and mainstream, like large scale and mainstreaming of the activity? I thought I would leave you with some 3 points, essentially as food for thought. That's going to be helpful for commercial investors or private finance to be mobilized. One, I think help and support is needed in accelerating climate and nature-related financial disclosures, particularly in emerging markets and developing economies. Financial sector essentially is in the business of taking risks. And financial sector can take more risks when they understand the risks a little bit better. It's as simple as that. And when there is better disclosure, particularly in the developing countries, around physical and transition risks, we can expect the financial sector to best adapt to that changing climate, build the resilience in the financial sector, and scale up investments to meet the adaptation funding gap. Today, I think in the developed world, it's expected that every company reports according to TCFD, which is the Task Force for Climate-Related Financial Disclosures. So what is your exposure to climate risks? And I think emerging markets sort of adoption of that is missing and needs to be accelerated. And we are observing that the investors are now taking that physical and transition risk data and integrating that into their credit and IRR models as the next sort of phase. So it's already started happening. The regulations are moving to that quite quickly. So we need to make sure the emerging markets, developing economies are on the same trajectory as the developed markets, because otherwise you risk the capital flight. And as people are more incentivized to put their money into 1.5-degree aligned resilient investment opportunities, the lack of data means the capital is going to be much more difficult to move, right, to emerging markets. On the other hand, in making investments more resilient, I think the biggest opportunity to close the adaptation funding gap exists. For instance, we had UK's BII sort of showing us in a very smart way that investing into a solar farm in emerging markets now needs to take into consideration mangrove restoration, for instance, opportunity attached to that as part of the ecosystem services, right? The Zephyr Power project, which built 50 megawatts wind power in the Indus River Delta in Pakistan, also had a very sort of nature-based solutions attached to the project design, which the investors really liked. So it doesn't necessarily have to be a separate asset class or separate investment. When you look at infrastructure investments, think about the adaptation requirements and make sure it is part of the package. So one, understanding the risk and embedding that into the investment process. Two, innovation in financial instruments, particularly in the insurance segment. In 2018, Swiss Re, in collaboration with the Nature Conservancy and regional governments and the tourism industry, launched the world's first nature-based insurance solution to protect 160 kilometers off the Mesoamerican reef along Mexico's coastline. which is referred to as the best example of how you can innovate around adaptation and bring private sector money. And ever since, there has been more examples of it and extension of it. So the case studies are out there that can be leveraged, and financial innovation is, able to pull in private sector money. So let's demonstrate those examples and let's replicate. And also on the more mainstream
Sorry, Denise,
side.
very briefly, if you will, on this last point. I'm worried about time.
And the third point, I think, support growth of new solutions. We talked about data requirements. I think there's more money that needs to go into climate analytics technologies that help, obviously, understand climate risk, but also solutions attached to it. And nature-based solutions is an asset class, which is a very sort of direct way of private sector putting money into adaptation that can be supported in growth.
Thank you. Well, I think you may want to come in on some of those points to respond, but I want to bring Annalisa in, and we can come back to your point in a minute. Annalisa, I think you've been, your research kind of covers the MDB angle to all this. I wonder if you could outline your thoughts there, and if you have any responses to Denise also, feel free to wrap them in.
Absolutely, and also good afternoon, good evening, everyone, and also to kind of build on what Chintz has already kind of elaborated on the role of multilateral development banks. I mean, here we're kind of talking about finance for climate, and we need to kind of acknowledge and be very clear that without the support, grants and loans from multilateral development banks, the international climate finance target wouldn't be in sight. I mean, just to kind of cite, just 10 days ago, more or less, the latest edition, the 2021 joint report of multilateral development banks of climate finance was released. So we have the latest numbers, and we're talking about a total of climate finance of around 51 billion. So this is a kind of a huge contribution towards the international climate finance target. We're not yet there, but it's a kind of a considerable kind of contribution. And again, we're talking about the split and the allocation between mitigation finance and climate finance. We're moving closely to the 50-50% now. It's 2/3 mitigation finance and 1/3 adaptation finance. And I'm sure Chintz was heavily involved in the kind of drafting of the report and the kind of data validation. So certainly there's a key role that the multilateral development banks can play. We heard I was in Washington, D.C. 10 days ago. Colleagues were at ANGA. There's certainly a kind of a huge kind of focus for multilateral development banks to deliver more on the climate agenda, and they have to be part of the solution. But there are certain kind of issues, as I say, that should be kind of greater leadership from the perspective of multilateral development banks to deliver, and it's much more than, I mean, remarks or lack of remarks from presidents of the World Bank in there. It's much deeper than that. For me, there are three major changes that should kind of happen. First of all, there's an element around changing the narrative. So we need to have multilateral development banks to deal with climate change together with poverty eradication and shared prosperity. I mean, climate and development shouldn't be a trade-off. They should come hand in hand. And what we need to kind of analyze and be very clear is around the kind of synergies. We know that a kind of a climate resilient economy will also be a less risky economy and will be a kind of a different kind of development path. Second, and this is something that Chintz has kind of alluded to earlier on, is around changing also the technical assistance that the multilateral development banks to provide. It's really very much kind of showing what kind of climate smart development strategies can be offered, and they should be kind of more safe on energy security. I mean, and this is about having less dependence on fossil fuel. It's about lower and more predictable operating costs, so more energy efficient with no fossil fuel inputs, and also to kind of show that there are co-benefits in terms of job creation, clean air, and increased fiscal space in the medium term. But the final point is around also changing the instrument. That's something that Denise and Cinzia kind of talked about. And I remember kind of when we were kind of advocating for a more strategic use of concessional finance. This was actually raised by Secretary Yellen in a speech. She gave a curtain raiser speech at the Center for Global Development before the annual meetings. And she really spoke about using concessional finance also in middle-income countries, and that includes climate change adaptation and mitigation. I mean, for example, if solar has higher capital cost and risks, deploy guarantees to manage this and build a market. I mean, we have examples in Tanzania and India quite successful. Or in manage the kind of exposure to climate risk, and I'm talking about the hurricane clauses that the Barbadian government has kind of aimed to achieve. So there are certain kind of elements in terms of the narrative instruments and technical assistance that MDBs should do differently. But if I may, Will, if I have a 1.5 minute more, it's not only about the supply of finance, it's also the kind of demand of finance. And this kind of applies to both climate change adaptation and mitigation. I mean, first of all, when we talk about adaptation, it's always kind of local solutions and not necessarily all the institutions I've just talked about might be really well placed to do so. I mean, it might happen with different kind of instruments. And then we need to understand the demand coming from the client countries. I mean, last year we spoke with nearly 500 government officials in more than 70 low-income and middle-income countries. We asked them about how they see the relevance, the effectiveness, and the future of multilateral development banks. But we also asked one important point, where they wanted MDBs to operate in the medium term, in terms of sectors and activities. And we found two very interesting points. First of all, the staff of multilateral development banks had very different opinions from government officials in terms of the kind of sectorial priorities. And the second key point is that while for the case of staff in multilateral development banks, climate change adaptation and mitigation were considered kind of top priorities, this wasn't the case for government officials. So I think this is a kind of an important point, and it goes back again to the issues that are raised in terms of MDBs, but also other financiers to kind of raise the bar on climate change adaptation and mitigation. Is around changing the narrative, the instruments, and the technical assistance, again, to change the incentives for client countries to demand more and being able to access, particularly when it comes to climate adaptation finance.
Thanks, Annalisa. I am a little bit worried about time, guys, so I'm going to open it up to audience questions, if that's all right. Does anyone have any questions for our panel? Don't all go at once. Yeah. Can we get the microphone? Okay.
I'll chuck one in.
Thank you.
Quite interested to hear what you think in particular, excuse me, I forgot your name, Denise, to hear your views on what you think the role of EU regulation is when it comes to actually defining climate adaptation, and whether that's beneficial to actually attracting those capital flows in the right direction, or whether it's in a way creating a barrier as well. Speaking about the EU taxonomy specifically.
Yeah. I mean, it's another framework, or an important framework that helps, I guess, with the definitions around what needs to happen, and you know, how we need to rethink how we allocate capital. And it's just one of the drivers, right, that motivates financial services to doing something more responsible, more sustainable. I think it's a matter of the opportunity presenting itself as well, right, as the panelist was just referring to. I mean, where's the demand for financing come from, right? You know, there's the role of the regulations and frameworks and the reporting and disclosure requirements in sort of mainstreaming an activity, and they're all important factors. But unless a Kenya issues an adaptation bond, or you know, there's a new insurance product or a like infrastructure project that includes a very strong adaptation element in Nigeria or India, whatever, like the money is not going to move there just because there's a framework around it. So I think we need to see a balanced or holistic approach to all of these issues where capacity building also needs to go to the developing economies around these topics, especially around what EU taxonomy is setting out the investors to do.
Thank you.
Does that help? Sorry.
Yes, absolutely. Yeah. Very relevant. Thank you.
We've got time for another quick one. If anyone, the gentleman over here in the second row, please.
Thank you so much for that illuminating conversation. I work mostly with governments at an intergovernmental organization, and most governments struggle to really prioritize sort of, the sectors they need to focus on. So if I could ask the panelists, any one of them, to name the top 3 sectors they would like governments to prioritize for adaptation, especially when we talk about LMICs, LDCs, and SIDS, and top 3 for mitigation, and that could be, I suppose, for everybody. So it would be great to hear, and I'd love to take your message back to the governments I work with. Thank you.
Do you want to have a go at that?
I hear all of the question. Could you repeat that part for me?
Sorry, sir. Would you be able to
top
say
3 sectors you would want governments, particularly in the South, to sort of prioritize for adaptation, because they have to put these proposals together and to access climate, and top 3 for mitigation.
Sorry, what happens when...
Sectors. So transport, energy, infrastructure, education, health, what is it? Because governments, mostly don't really have the clue.
Loads. There's quite a lot that could count as adaptation, that would count as adaptation, where you could invest in you could invest in it. One of the issues is that some of these markets are either quite small, or the returns aren't entirely predictable, or the consumers are quite atomized and individually quite small. That's not going to be fixed just by private sector. It's not going to be fixed just by private finance. Private finance here and public finance and interventions are complements, not substitutes. And one of the things that at CGD we've been working on is the use of pool financing mechanisms, which aim to sort of remove some of those barriers by either aggregating consumers and sort of guaranteeing large purchase volumes, or incentivizing large-scale production to drive down price towards the point where market demand would be sort of substantial enough to sort of sustain the market. That's not really happening very much at all at the moment. So I think the status quo where we are right now is that for a lot of adaptation, potential adaptation sort of opportunities, the market's not quite set up, ready for large-scale private investment. That's not the case necessarily for mitigation, because a lot of the mitigation, a lot of things that you can do for mitigation will also be for much richer places where there is a demand for, say, changes in sort of high carbon intensity industries, which will be driven by regulation in rich countries, which is not necessarily the case in developing countries. And so the sort of pull really for private finance is potentially much larger in mitigation, so it needs a little bit more of a helping hand on the adaptation side. That's not an area where I think policy has caught up with yet. I don't know if that answers.
Thanks. I'm afraid we're really at time, guys. We're running a little bit over time. So thank you both for joining us. Thank you both for joining us on the screens. Really appreciate you all coming in. And thank you to all of you in the audience. Devex is going to be at COP27 in Sharm in a couple of weeks. We're going to be running an event there, podcast. So if you have any questions, do come and see us afterwards, and we look forward to seeing you next time.